Hey guys, you are tuning into Agent on Duty with myself, your host, Stacey Prieur, and today I have Bernie Klacer coming back from Real Mortgage Associates. I've actually received an overwhelming amount of viewers asking us about this cashback mortgage and partnering with their kids. And in fact, I actually kind of got in trouble. So I just thought it would be great to have you back on this episode and kind of go through and deep dive into these topics that we talked about with the cashback mortgage, investing with your children, investing in properties, and also getting into the vacant land and building a new build and how it works with the mortgages. Are you ready, Bertie?
Sure, I'm ready.
One of the things that I got approached by was a parent said that they were watching this with their child. The parent said to me, "We do have equity in our home. We're actually mortgage free. And how would that work if we took out a lump sum? What happens if our home devalues because of this inflation or this bubble?" And I'm like, whoa. Let's get off the bubble talk first and foremost. So as someone who's been in business for I don't want to out you with your age, but it's been 20 plus years.
Well, I've been a mortgage broker for almost 15 years. So
You've seen some stuff. You've seen the market. You've seen what happened when 2008 that was the big kerfuffle. That was our last big kerfuffle. But one of the things that I wanted to reiterate to our viewers is that the homes never actually devalued, as in they didn't go down 100K ever. Bernie, have you ever seen that?
thankfully not in my lifetime, Stacey. They plateau. I think I talked about that before. Is it in 2008 we just saw it just stopped, and then there's about a 6 or 7 year of 1 or 2% growth, and then the last 5 years has just been crazy. So I haven't seen it actually go down. But the banks protect themselves when they lend money, so we don't lend to the full value of homes. So you don't need to get super scared unless you're putting the 5% down, which is a whole other conversation.
So I just wanted to kind of reiterate this to anyone that's out there that's watching. Even if you have 100K left on your mortgage, but you purchase your property, say for, I don't know, 250, now it's worth 657, you got some cash to play with. Your home is your bank. So instead of lending from the bank where the interest rates are higher, lend from your home because you have equity to play with. There used to be a huge stigma with this, where if you refinanced your home, it meant that you were in serious financial trouble and then you wouldn't potentially be able to sell your home for that amount because of the stagnation, and the growth was only between 2 and 5%. Now we're seeing leaps and bounds. So when you're earning equity in your home, that gives you some buying power, whether it's refinancing for renovations or whether or not you want to take a big chunk of that out and reinvest in another property. And the reason why I was saying this was because Bernie and I were talking about this cashback mortgage. So basically you're doubling down your assets. So if you're sitting at home and you have stocks and bonds, you have RRSPs, you have a tax-free savings account, what you also can do is take that money, take a nice big chunk, because you want to put down 20%, not just the 5%. And if your kids are already renting, they're giving someone else a mortgage payment where they could be giving you and them a mortgage payment. So you're really investing in their future as well as yours, and you're partnering with them. You're not just giving this to them because you're growing your asset and they've also now got an asset as well. In terms of liability, Bernie, from a mortgage perspective, what would you say that people would expect?
Well, the banks only lend 80% of the current market value. So, as a liability to the bank, it's not going to be a huge deal. But it's just depending on the parents, how much they want to help out their kids, what they're comfortable lending their kids. But, obviously the money will be secured against their home at a 2.5% or a 1%, depending on what kind of term. But there's really not a huge liability as long as they can make the payments. And if we set it up as a line of credit, then it's interest-only payments. But it gets the kids into the market before they can't get into the market. And they're both growing an asset, right? So that the parents are helping their kids. So then the kids don't have to come back to the parents and ask for money in the future, right? So it's kind of giving them a kickstart, a kick in the butt to get going. So it's a really good plan.
Or ask if they can live in the basement. I've done that a couple times. We're going to go ahead to break, and then when we get back, we're going to talk about this cashback mortgage and what the details are with it. So please stay tuned, and we'll be right back. All right, guys, welcome back. You're tuning in to Agent on Duty with myself, Stacey Prieur, and my guest today, Bernie Klacer. We are talking all about mortgages. Now, Bernie, we were talking about a product called the Cashback mortgage option. I was wondering if you can explain that to our viewers a little bit more in depth.
Yeah, sure. So we have a few lenders that'll offer cash back based on the mortgage amount. Usually it's 1, 2, or 3% of the mortgage being lent. So if I lend you 300,000, there could be 9,000, 6,000, or 3,000 lent back to them. Not lent, they're just given back on close. So that money can be used for renovations, can be used for purchasing furniture, or we can pay the parents back if they help them out with a down payment. So that's was our strategy that we discussed, where they
Mhm.
can't come up full 5%, but we can kind of help them with the 3% to get sorted to the down payment. So it's a great product. The only thing is the interest rate's a bit higher, so you're borrowing that money over the term of the mortgage, the 5-year term. So the bank's not going to give it to you for free, but it's definitely a way for the kids to get into the house now instead of later.
And one of the things that we were talking about and why this is such a huge benefit is, say again, just to reiterate, if you didn't see the first chunk, say you have a home that you purchased for 285, now it's worth 650, and you only have 100K remaining on your mortgage. Say you were to help your child invest, because right now, like townhouses in London are going from 375 to 425. So if you're doing 20% down on a 400,000 mortgage, that's a huge chunk of change that not a lot of people have. That's 80K. So say you had a mortgage, again, you have this house that's worth 650K. You only owe 100 left on your mortgage and you want to take out 80K. So you can help your child with a down payment and avoid CMHC and put that 20% down. Now, the parent's mortgage would now be 180K. What type of additional payments are we looking at?
You're for about 80K. You're talking, like, if it's 1.5, 2%, you're talking a few $100, $300 a month on that kind of mortgage. So for $300 a month, the kids could save like a $400,000 house. The CMHC is almost $20,000. That's the CMHC that money goes out the window. It gets added to the mortgage, so you lose that equity like that. So the parents would be helping to save that CMHC money out the window, the insurance premium. So for $300 a month, it's a good deal if the parents have that kind of equity and are willing to help, and they're going to pay that mortgage back at like 1.5, 2%.
Now,
And that's actually better than the cashback program,
absolutely.
obviously.
So, and if someone was to purchase a home with 20% down and a 400,000K mortgage, what kind of payment would an average payment be?
I think it's about $1,200 on 400K mortgage.
So, for example, which is great,
Yeah.
those are the numbers that I'm talking about because right now people are renting at 1,500 to 2,000 for a 2 to 3 bedroom or home. So if you have a kid out there that's renting for that much, they could literally be paying their mortgage for about 1,200 plus pay you back the 300, make those installments so they're paying the additional mortgage and you both own a property. So what this means is that your equity portfolio has now grown because if you've ever played Monopoly, you don't just own one house, now you own part of two. And then now your child owns a nice little house too. So this way, for peanuts on a dollar, like you're literally pulling out your mortgage, giving it to your kid to put into another home. It's only going to cost approximately 300 bucks more, maybe hypothetically. Your kid now is still making the same payments they would be making renting, but now they're growing equity in a home with you, not paying someone else's mortgage. And it's no cost to you because they're paying the extra 300 that you would have been paying on a mortgage anyways. I honestly, I don't know how it doesn't make sense to other people. And I know that this isn't a common practice that people think about. So in terms of refinancing and penalties though, what could someone anticipate? Like what would be the cons of doing this, Bernie?
The only con would be is if they get stuck with a bank and put in a fixed rate mortgage. So, you know, depending on how we set the mortgage up on the parents' house, then I would do a variable probably just if they wanted to pay it off faster. Or you just set up the 80,000 as a home equity line at 3% when it's fully open so the kids can make double payments. So I've done that with some clients is where they just put that 80,000 as a home equity line. It's at 2.9. It's a little higher than the 2% mortgage rate, but it's fully open. So the kids can pay 1,000 a month instead of that 300 if they're able to. So then they can really pay that $80,000 quickly. And you're right, it helps the kids. They get their own place, and then really they're not going to have to come back to the parents to help again because they have their own house. And in 3 years, I can maybe even refinance the house and pay the parents back 50,000. Like so, there's pros to everything. It's a great idea, but the parents got to be on board.
And how long would the parents have to be on the mortgage for?
Well, they'd have their own mortgage, right? So it's just depending on how fast the kids could pay them off, right? Because the kids would have their own mortgage, and then the parents would have their own mortgage. So there's two separate mortgages.
Yep, I just wanted to clarify that.
Yeah,
So this isn't a co-signing proposition. If
no,
you wanted to co-sign, that's a completely different ballgame, correct?
100% correct. This is not co-signing.
So if someone wanted to get a mortgage for, again, around 400K, what base salary or wages would they have to be making, and for how long would they have to be doing that for?
So they want to be full time, it's full time salary. So kind of the rule of thumb that I always use is 250,000 mortgage, you need a 50K income with no debt, no car payments, no lines of credit. So 50. So 100K would get you $500,000. So 400, you're looking at probably 75 to 80K gross income with no debt. So it's tough now with all these new rules, and next week it's going to be even tougher. People are going to lose about 4.3% affordability with the new stress test.
And what's the thought behind that? Why are they changing and upping the stress test as if it wasn't hard enough to get into things?
I think the government's just trying to cool the real estate market, right? So that's what they're going to try and do. And I think it's going to work a little bit, but I don't think the rates will ever go up to 5.25 because our economy can't sustain it. People are just leveraged too high.
And I just want to clarify this too. The stress test rate is not the actual rate you get charged.
100% correct. So when I base the mortgage payment on a 5.25 interest rate, so your payment would on 500,000 is almost $3,000 a month, but you're only going to pay 2,000 a month with the current rates.
So I think that kind of clarifies that. We are going to head to break. And when we do get back from break, we're going to talk a little bit more about investing in properties. So not just partnering with your parents or partnering with your children, but what happens if you want to take that equity from your home and now you're looking to diversify your portfolio? We'll get back into that in just a minute. So stay tuned. And guys, we are coming back from break. If you're just tuning in, you're watching Agent on Duty with myself, your host, Stacey Prieur, and my guest today, Bernie Klacer with Real Mortgage Associates. So now we wanted to get into a little bit more about investing in properties. And the reason why, so if you don't have kids, but say you have friends that you want to, I know I kind of tickled this last time, but I do have some friends that have some equity in homes and they want to start building rental portfolios. So one of the things that we're currently looking at is A, how many people can invest in something? B, is it better to use our personal names and buy other properties? Or C, is it better to go in under a numbered company? And from a mortgage perspective, how does that work exactly? So we'll get into number one. If you want to invest, is it better to go how many people and then numbered or not numbered?
If you're going to go with just names, it's usually 4 people max on a mortgage, 4 people maximum. So that's the max I've ever had, and that's usually the banks cut it at 4. That's for your personal name.
So say I'm partnering with one other person. Is it better to put these investment properties in our individual names, like I buy one, she buys one, but we kind of split the profits? Or is it better that we create a numbered company from a mortgage perspective?
So the reason you do a numbered company is it's usually for liability. And if you have a number of different investment properties, if you have 1 or 2, it probably doesn't make sense to have a numbered company. But you'd have to talk to an accountant for that. But if you have a partner, though, they have a numbered company, so you could buy, you put it together. The only problem is with mortgages, numbered companies are harder for us as mortgage brokers to do. Our channel is kind of limited to what we can do. So you'd have to go to a bank to do their small business type mortgage, but they do offer it with 20% down, best rates. But you'd have to visit a local branch, unfortunately. We used to do some of the numbered company mortgages, and we still do have a couple lenders, but it's a little tricky.
Now, and how's that affected by the home equity loans? Like, does that like make a difference or?
Well, the good thing is if you have houses in numbered companies and then you want to buy houses in your personal name, they don't show up on your personal name. So you could actually buy a couple in your personal name and then buy a couple in your company name because the banks don't like to have more than five in your personal name. So some people have six or seven, but three are in a company name and five are in their personal name.
And why don't banks really like that? Is it because they take into account just your sole income, or how does that work?
They basically say you rely heavily on rental income to service your portfolio. So that's what they usually say, but it's more of a liability because if you go bad, you're going to go. That's what they say. If you're going to go bad, you're going to lose your rental houses, and if you have five or six or seven, you don't really care about the fifth or sixth. But I disagree. Most people that have lots of properties aren't going to throw their money away.
Now, isn't this something that happened in Florida? I mean, it's not very common in Canada, but back in Florida, when people were investing in all these timeshares, doesn't isn't that one of the reasons why that came into play, where you're only allowed a certain amount because then everybody went belly up?
I believe it. I don't exactly. The timeshares is different though, right? Because it's a different kind of corporation, things like that. But yeah, you don't want to spread yourself too thin, and that's what the bank's too worried about is when you have too many properties, you're really thin. If something goes wrong, you don't have a lot of capital.
So, with that in mind, I do want to talk to you a little bit more. I wanted to get into the new build situation because we were talking about that and buying vacant land and then building your own home. Because with the limited amount of resale going on and the builder's backlog, there has been so many people out there saying, I want a new home or I want this, I want that, but I'm not finding what I want. So, I wanted to talk to you a little bit more about that option as well and from a mortgage perspective and just dive into it a little bit more. We are going to take a quick break, and when we get back, we will get into building and vacant land. Stay tuned. Hey guys, if you're just tuning in, you're watching Agent on Duty with myself, your host, Stacey Prieur, and my guest today, Bernie Klacer from Real Mortgage Associates. I got into some hot water with a client because they said they were tuning into Agent on Duty and they heard all about us sharing the story about how parents should help their kids and take equity from their home. So we talked quite extensively about that, and I hope we clarified any miscommunications. We also talked about the cashback mortgage. We talked about investing in properties. And now we're going to deep dive into if you want to build and custom build yourself, what does that look like from a mortgage perspective? So, Bernie, just to clarify again, what do banks view lending on vacant land? Like people can't just be like, I'm going to get a mortgage for this piece of land, can they?
No, it's with vacant land is you basically have to pay cash for it. So what we usually do is refinance existing home, but some lenders will do 50% loan to value. So that means if you buy something for 400, they'll lend you 200,000 on that. So you need a good chunk of change to buy a piece of land. And that is the starting point of building your own home. People don't understand you got to buy the land first before I can do a construction mortgage. So it's very important to establish that first.
Yeah, so you just kind of said right now, so if someone currently owns their own home and they have, again, that equity that we've been talking about that's been building over the last 4 years in leaps and bounds, you can technically do a refi, and that would be your cash that you would be paying for this vacant land, correct?
100%. Yeah, that's usually how people are buying the vacant land. We refinance their house, existing home, buy the land, and then we start with a construction mortgage on the new house.
And what happens in terms of penalties if they go to sell their house, like once the home's built? So usually right now, homes are typically going between 6 and 9 months for a new build. So would they still incur a penalty for doing this refinancing and then selling, or how would that work?
No, what I usually do is if they're buying the land, we'll set up a home equity line of credit. I won't put it in a mortgage. So that
Okay.
way it's fully open. It's a little higher rate, but there's no penalties to pay it off because I know they're going to sell that home.
Yeah, that's pretty easy. Pretty easy to guesstimate these days. So, guys, if you're thinking of doing that, again, you currently want to take the home that you're in, you're wanting to refinance your mortgage, take that money to invest in the vacant land that you're interested in purchasing. And then let's talk a little bit more about new construction mortgages. How does that work?
That's a whole different ballgame. So once the land is purchased, then the clients will we'd have to set up a construction mortgage. So they'd have to get some plans from architects, they'd have to get permits, and then or if they're going to find a builder. So there's lots of homework that needs to be done before we could do a construction mortgage. But it's a good process, but it is a little complicated.
So once their homework's done, say they've done this, and what would they need to qualify for a construction mortgage?
It's basically they'd have to qualify for a brand new mortgage on their own, pretending they're going to sell their home and we're going to set up the new one. So it's all the same kind of requirements, but it's just the way the money's released. It's in draws on a construction mortgage, so it's a little different.
When you go with a builder, typically most builders they expect 25 to 30 grand up front. So that would be considered one of the draws, right?
No, that's when you're building with a builder, that's just your deposit. So the builder funds the whole thing on their own. That's why you pay the top dollar when you're buying it from the builder, because they're paying all the expenses. When you're self-building, you save a lot of money, but it's a little more complicated to get the money.
And that's exactly what I was hoping you would say, because it is a common misconception that people face. They're like, okay, well, this is going towards the builder and blah blah blah. So I appreciate that you kind of explained that a little bit more. Now, when you go with the new builders, a lot of times there's the Terran warranty and all these other warranties. I know you were personally thinking about doing a build. How does that work with, again, mortgages and the warranty part? Because isn't there a little extra that you have to invest in?
So yeah, so if I pick a builder to build a house for me, I could pay I think there's a $15,000 Terran warranty, but it's a self-build, so you shouldn't do that. The only problem is financing those. It's just the big banks finance non-Terran warranty houses. So that's something people have to understand is like the First Nationals, MCAPs, the monoline lenders won't finance new builds until they've been built for at least a year. So then you can finance it. So you got to be careful financing the new builds without the Terran warranty. Sorry.
I wanted to bring that to your attention because a lot of people, again, they don't know that. They don't know what the difference is between having a Terran warranty, having not a Terran warranty, and their risks and liabilities. So, guys, if you've been tuning in and if you're interested in partnering with your children on taking some of the equity in your home, if you're interested in doing investment properties with some friends or family members, or if you're interested in building a new build, definitely give Bernie a call. Bernie, how can everybody get a hold of you?
Well, they can go to my website, justaskbernie.ca, or feel free to give me a call on my cell phone, 519-857-8575.
Perfect. Well, thank you guys so much for tuning in. And Bernie, thank you once again for being on the show and also explaining this in detail. If you guys are out there and you're watching and you still have questions, email Bernie. Anyways, thank you so much for watching, and we'll see you next time. Bye.